Welcome back to Pensioners Corner. In today's update, we're covering an important development that affects many pensioners, retirees, and anyone in the UK with savings above £10,000. HMRC has confirmed changes in how savings and interest income will be reviewed. For people over the age of 65, these adjustments could influence how much tax is collected and, in some cases, how certain benefits are calculated. This is not speculation, and it's not designed to worry you. It's simply a clear explanation of how the system is changing and what it might mean for your finances. Our goal is to make sure you're aware, prepared, and informed so that you can take steps to manage your money wisely. Over the next few minutes, we'll break down what this new HMRC approach involves, why it's happening, who might be most affected, and what legal and practical steps you can consider to help protect your savings. The first thing to understand is what exactly is changing. Until now, much of the information about savings and interest income was collected through annual tax returns or yearly reports from banks to HMRC. That meant there could sometimes be a delay before adjustments were made to a person's tax code or benefits. Now, HMRC is moving towards a system where this data will be reviewed more frequently, using real-time reporting from banks and building societies. In practice, this means that if you have more than £10,000 in savings and you're earning interest above your personal savings allowance, HMRC will be notified more quickly. As a result, tax codes can be adjusted sooner, and benefit calculations may also be updated without the delays we've seen in the past. So why is this being introduced now? There are three main reasons. First, the government wants to reduce the amount of unpaid tax by closing the gap between what should be collected and what actually is. Interest income often went unreported in the past, simply because of how the system worked. Second, advances in technology now make it possible to share this information automatically. Banks can securely pass on details of interest payments without waiting for the end of the financial year. And third, the government argues this creates fairness by making sure everyone pays the right amount of tax at the right time, without relying on individuals to remember to declare small amounts of interest themselves. Who is most likely to be affected by these changes? While technically anyone with savings above £10,000 could be included, the group most impacted will often be pensioners and retirees with moderate savings, typically between £10,000 and £50,000. Those with very large amounts are usually already used to declaring their income and completing tax returns. But many ordinary pensioners, who may have never needed to file before, could now see automatic adjustments applied. The people most at risk of noticing a change include Over-65s receiving means-tested benefits like pension credit, housing benefit, or council tax support. Retirees with fixed incomes who rely on savings interest to supplement their pensions. Homeowners who keep cash reserves for emergencies or future care costs. Now let's look at how this could affect benefits. Certain benefits are means-tested, meaning your savings and income are taken into account when deciding what you receive. Pension credit, for example, assumes that savings over £10,000 generate what is called a notional income of £1 for every £500 saved. That means if you have £20,000 in savings, you may be treated as though you're receiving an extra £20 each week, even if the actual interest earned is less. Over a year, that could reduce your entitlement by more than £1,000. Housing benefit and council tax support can also be reduced if your savings are above set thresholds. With real-time reporting in place, these adjustments could happen more quickly than before. Taxes on interest income are also an important factor. In recent years, interest rates have risen, which is positive for savers. But it also means more people are crossing the tax-free savings allowance. Basic rate taxpayers can earn up to £1,000 in interest without paying tax. For higher rate taxpayers, the allowance is lower at £500. Anything above these limits becomes taxable. With the new system, banks will report this interest more frequently, and HMRC may change your tax code automatically. Instead of receiving a bill at the end of the year, deductions could be made immediately through reduced pension payments or adjustments to income tax. How will HMRC enforce this new rule? The key difference is automation. Rather than waiting for people to report savings, HMRC will receive the data directly. This removes the risk of underreporting and reduces errors. If an adjustment is needed, HMRC can change your tax code and notify you by letter. In some cases, benefit payments may also be recalculated. While this creates efficiency, it also means changes can happen without warning, which is why awareness is so important. So what can you do to protect your savings? There are several legal and legitimate steps you might consider. Use ISAs efficiently. Interest from ISAs is tax-free and does not affect means-tested benefits. Keeping money in these accounts can shield savings from unnecessary deductions. Spread your savings. Distributing money between different accounts may help you stay below thresholds where possible. Keep accurate records. Document your interest payments and keep any letters from HMRC. If there are mistakes, you'll have the information you need to challenge them. Review alternatives. Some products, like premium bonds or certain national savings certificates, offer tax-free returns that don't count as interest. For those comfortable exploring options, certain investments may also provide tax-efficient growth. What are financial experts saying? Advisors and campaigners note that the biggest issue here is awareness. Many pensioners may only learn of these changes when they notice reduced payments. Banks are already warning customers that data sharing will become more frequent. Meanwhile, campaigners are asking HMRC to make their letters clearer and easier to understand, so pensioners know exactly why changes are happening. As we move towards the conclusion, here's the most important takeaway. If you have more than £10,000 in savings, these HMRC changes are likely to affect you in some way, whether through taxes, benefits, or both. The key is not to panic, but to prepare. Make sure your money is placed in the most tax-efficient accounts, such as ISAs. Double-check that your tax code is correct. If you're unsure about how these changes apply to you, it may be worth seeking independent financial advice. To summarize, this new rule represents one of the biggest changes in how savings are reviewed in recent years. It's designed to ensure accuracy and fairness in the tax system, but it does mean that pensioners who have saved carefully could notice differences in their income. No one is being punished for saving, but the government is making sure that interest income is captured in real time. That makes it even more important to stay on top of your accounts, know where your money is held, and take advantage of tax-free options where possible. Here at Pensioners Corner, our mission is to keep you informed and prepared for changes like this. By staying aware, you can make smart decisions to protect your hard-earned savings and retirement income. If you found this update useful, please consider subscribing to the channel for more straightforward explanations of pension and HMRC news. And don't forget to share this with friends or family members who may also be affected. Your financial well-being matters, and the first step is knowledge. Thank you for watching, and we'll see you in the next update.